what would a couple more rate hikes get us?
Well, let me be very clear. I think one rate hike is probable, two is possible, and it depends very much on just the conversation we're having, right? We've seen a little bit of what appeared to be a reacceleration. A number of the incoming data, high-frequency numbers, admittedly, were suggesting, a lot of forward momentum in the economy. We still have a very, very tight labor market. And so, with the data-dependent Fed looking at every number, one could imagine a situation where another hike, two hikes are called for. I'm not saying that's likely. I'm saying let's not just simply rule it out and say it's one and done. It's one, and then let's wait and see, because the situation is murky. And the Fed was very clear in its last set of minutes. While there were arguments on both sides, the vast majority seemed to think that the risk for inflation was still more to the upside.
Is it your expectation that Friday's speech will frame that, or is it going to be sort of a longer-term thesis on monetary policy?
I'm not sure. I rather hope that it sort of frames where we are and builds and elaborates on the minutes, because I think that's the thing that's most important. There may be some longer time frame discussion, but right now everyone wants to hear exactly how the Fed is thinking about those minutes and any elaboration, because the minutes had a little bit of everything in them. A general sense that inflation is still too high and we must be resolute, and then most people thinking upside risk. But we had two individuals who clearly said they would prefer to have stopped, and there's clearly a notion that the risks are much more balanced. So I think it would be nice to hear from the chairman, any elaboration he wants to make around, a number of different themes that are in those minutes.
Tony, it appears that you are in the recession camp, despite the fact that a lot of market participants in recent weeks have basically come to this consensus that we are maybe potentially avoiding a recession this time around. Why do you feel differently, and how do some of the lag effects as it pertains to treasuries and corporates and mortgages play into your thinking?
Well, Leslie, it's a great question. And so I've gone back and I've done a Google search for you pick the Fed chairman and then soft landing after it. And what you'll find is each time before the recession begins, before the credit gets worse, you get a call for no recession and a soft landing. It doesn't happen by magic. When you look back at the 1995 soft landing, right before I came on, to make sure I had it right, the 10-year Treasury yield went from in the fourth quarter of 1994, it went from 8%, and by the beginning of 1996, it dropped down to 5.5%. So it wasn't magic that you had a soft landing. You had a dramatic improvement, not in the absolute level of rates. So where we are today is mortgage rates are at a high. Corporate rates are stable and where they were about a year ago, but the credit spreads have narrowed because the 10-year's gone up. That's not what you want to see. You want to see the rates come down to make financing cheaper, and the Treasury yields are higher. So all those areas that really drive expansion in the credit market are not getting better. They've gotten worse. And again, this sounds so Armageddon negative, and I'm not, because the time for that was really last summer. Now a lot of stocks, more than 50% of stocks are still down 20% from their 52-week high. So a lot of stocks have reflected it. So our positioning is what we call light and tight, to be able to take advantage of weakness when bad news becomes bad news. So carrying a little bit extra cash and a slight defensive bias. I don't want to get too negative, because then it makes it really hard to attack the weakness as it comes.
But I see here in the notes that you are avoiding Megacap. In this scenario, wouldn't you want to at least participate in that to a certain extent? It's been a pretty narrow leadership, at least in recent days, in the Megacap tech world. Is that really an area to avoid right now?
I think it is, only because of this. Listen, I've proven I'm not a great trader, Leslie, so I'm not going to come on TV and pretend to say that I am. What I do know is that the top 10 stocks currently represent over 32% of the S&P 500. That exceeds anywhere it was last in November of 21 in the dot-com boom, and the most since 73, 74. So we're in a position where they've become too big a part of the market. I don't think, for me, I wouldn't advise an individual or an institution to put 32% of their money invested in domestic equities into 10 stocks, because that gives you too much concentration risk. So that's really where it comes more from common sense than any kind of great strategist call.
Hey, finally, Roger, you know, it's been an interesting couple of weeks thinking about where the neutral rate is. This piece in the Journal about R-star over the weekend, whether or not the target deserves to be moved, even after maybe we do get to 2%. I wonder your broad thoughts about that right now.
So my broad thoughts on the inflation target is we got to 2% internationally, but it was not driven by deep analysis. We've now had several decades of experience at a 2% target, and I would say once we're out of this, not now, but once we're out of it, a clear review to figure out what have we learned. I think one of the things we've learned is we stayed at very, very low interest rates for probably far too long out of concern about not hitting the 2% target. So maybe a target that's a little higher might be relevant. Too early to call that for now. On R-star, I think the main point is it's not measured with any accuracy. And so that's where we get this sort of feeling way along here. We have no idea what R-star actually is, and so the Fed attempts to approximate.